Is Figma's IPO a design for riches or a blueprint for buyer's remorse? Jim Cramer weighs in on Figma's much-anticipated IPO, warning that while the company's design software is everywhere, its stock might debut at a price that's hard to justify. Cramer urges caution, even as he praises the company's product and growth.
Search for flights from JetBlue, stream shows on Netflix, try to use Duolingo to learn a new language, or networked on LinkedIn. Do you know that you've used a product that was designed with Figma software? They already have 95% of the Fortune 500 as clients. Basically, this company has a whole suite of software that makes it easier for their clients to design apps and websites, and their product is so good that, well, Adobe tried to buy the entire company a few years ago. Who could blame them? Blocked by antitrust. You can tell by looking at the numbers. Last year, Figma put up 48% revenue growth, although that slowed to 46% in the first quarter of this year, and somewhere between 39 and 41% in the second quarter. These guys have more than 10,500 customers paying more than $10,000 in annual recurring revenue. ARR, that's how you measure this kind of company last year, up 45% year over year. 963 customers paying $100,000 in annual recurring revenue. And these numbers have both grown nicely this year as well. Now, Figma's net dollar retention, which measures how much money a software company's existing customers spend versus the previous year, came in at 134% in 2024, up from 122% in 2023, and only slipped to 132% in the first quarter of this year. That means their customer base keeps giving them additional business. Loved company. Best of all, Figma's actually profitable. Last year, their operating income grew by a staggering 369%, and the first quarter of this year was up 122%. Based on the preliminary second quarter numbers, that growth seems to have slowed, though. Free cash flow looks very nice. Now, I could talk about this thing, I like to talk about called the Rule of 40. This is a back-of-the-envelope way to judge enterprise software companies. You take the revenue growth, you add some version of the profit margin, and if the sum is above 40, you get a solid business. With Figma, we don't even need to do any arithmetic, because even in the latest quarter, the revenue growth was around 40%. Operating margin, positive. Rule of 40, excellent. So the numbers look pretty good here. But beyond the numbers, there's some issues. The first thing is I'm watching is what will prevail when two contrasting themes collide with this Figma deal. On the one hand, we've had a white-hot IPO market these past few months. A few really huge winners like CoreWeave, Circle Internet Group. You see that today? Wow. But plenty of more modest winners, too. On the other hand, even though tech's been doing well, enterprise software specifically has been pretty weak, maybe the weakest of all areas of tech. And some of the software companies that make tools for other software developers, they've really struggled, particularly software as a service or SaaS companies. Of course, the best comparison for Figma is Adobe. And we know that because Adobe tried to buy Figma a couple years ago, announcing a $20 billion acquisition in September 2022. I thought it was so brilliant, before eventually throwing in the towel at the end of 2023 after the regulators on both sides of the Atlantic refused to approve the deal. Unfortunately, Adobe hasn't been doing too well lately. The stock, by the way, is down 41% from its recent high set early last year. Figma has much better revenue growth numbers than Adobe, but Adobe's much more profitable. In the end, if this market doesn't like Adobe, you got to be at least a little worried that it won't like Figma either. And look, let's talk about why enterprise software is doing so badly. It's because this industry could be the first victim of new generative AI technologies, which have proven to be very adept at writing code, even from very simple text prompts. Adobe has some solid AI offerings of their own, but the newer AI companies, they keep rolling out products that can be they do basically the same thing in a much, let's say, more basic, less artful way. Now, Figma does have some of its own AI technology at this point, but CEO Dylan Field also noted that, I'm going to quote, AI spend will potentially be a drag on our efficiency for several years, end quote. And that makes me worried that the company might take a real hit to profitability for an extended period of time. Now, I recognize the need for these companies to spend fortunes on AI, but if Figma's operating margin goes negative, well, I don't think Wall Street's going to be too forgiving, frankly. At the same time, I am not thrilled that most of the proceeds from this IPO, roughly two-thirds, are going to existing shareholders, not the company itself. Figma expects to bring in $360 million from the deal, and they plan to spend nearly all that paying down debt. I like that, not paying for investments that could grow the business. I would have wished that they got that more. Now, there's nothing wrong with keeping your balance sheet pristine, and these guys don't really need the money. But you know what? I always notice when insiders are looking to sell a ton of stock, right as they're asking new investors to buy them. Throw in the fact that Figma was willing to sell itself to Adobe for $20 billion a few years ago, it makes you wonder just how optimistic management is about the future. All that said, based on the strength of the IPO market and the quality of Figma's numbers, I expect this deal will be very well received by Wall Street. In fact, that's already the case, as the book runners, the people who manage the deal, had to raise the price range for the deal last night, taking it from 25 to 28 all the way up to 30 to 32. Wow. There are reports that this IPO is approaching 40 times oversubscribed, even at the higher price. I get it. Figma is a loved product, according to everyone I surveyed. Using the new high end of that new price range and making some assumptions on what to include in Figma's fully diluted share count, this company will have an implied market cap of roughly $19.4 billion. So if the stock pops a little bit from there once it starts trading, it'll be worth more than the $20 billion that Adobe was willing to pay almost 3 years ago. Is that reasonable? Should you be looking to get into the stock around that level? Well, let's assume a 40% revenue growth rate for Figma this year, which is below the first quarter's growth rate, but around what they did in the second quarter. In that case, the company would have just over $1 billion in sales this year, and the stock could be valued at roughly 20 times sales, not earnings. Sales, if it rallies a bit from the high end of this price range. Adobe, the closest comparison, trades at less than 7 times sales. Even when screened for software companies with 30% plus revenue growth, that elite group mostly had price to sales ratios in the teens. Only the hottest of the hot, Palantir Technologies, comes in above that level. Could it happen for Figma too? Maybe, but I don't think this one has that Palantir magical elixir. Although I think Figma's going to be steaming hot. Plus, there's been a scarcity of quality deals, and the market will most likely go nuts when it gets one like this. So here's the bottom line. There's a lot to like about Figma, the company, but it's already coming public at a pretty expensive level. And if the stock roars right out of the gate, I'm going to tell you, it'll be too pricey for me, even as I think the company's got a tremendous product at a very reasonable price.